In this lesson, we will learn about advanced practices and reporting of tax due diligence. Creating tax-efficient structures outlines key strategies and considerations for achieving tax efficiency in cross-border transactions. Understanding the tax landscape. 1. Global tax compliance. Begin by gaining a comprehensive understanding of the tax laws and regulations in each jurisdiction involved in the transaction. This involves identifying differences in tax rates, exemptions, and incentives across countries. 2. Evaluating tax structures. Examine various corporate structures to determine the most tax-efficient setup. Considerations include the use of holding companies, subsidiary locations, and the flow of funds across borders. 3. Utilizing international tax treaties. Leverage tax treaties between countries to reduce withholding taxes and avoid double taxation. Understanding treaty networks is key to structuring the deal efficiently. Practical application. Let's take an example before delving into tax-efficient strategies. Consider a hypothetical scenario where a UK-based company acquires a tech startup in Germany. To optimize tax efficiency, establish a holding company in a jurisdiction with favorable tax treaties with both the UK and Germany. Structure the financing mix to balance debt and equity, considering the tax deductibility of interest in Germany and dividend withholding taxes. Align transfer pricing policies with market rates and international guidelines to avoid tax disputes. Implementing tax-efficient strategies. Debt and equity considerations. Balance the use of debt and equity financing to optimize tax benefits. Interest payments on debt may be tax-deductible, while dividends on equity may benefit from lower tax rates or exemptions under certain treaties. Transfer pricing strategies. Ensure that transfer pricing policies for transactions between group companies comply with international guidelines and reflect market values. This minimizes the risk of tax adjustments and penalties. Post-acquisition integration and restructuring. After the deal, focus on integrating operations in a tax-efficient manner. This may involve restructuring the business to align with tax-efficient strategies, such as centralizing certain functions in low-tax jurisdictions. Digital and e-business considerations. In cases involving digital assets or e-businesses, assess the digital tax landscape. This includes understanding how digital services are taxed and structuring the deal to minimize exposure to digital services taxes. Repatriation of funds. Plan for efficient repatriation of funds from acquisitions in other countries, considering the impact of withholding taxes on dividends and interest. Debt pushdown and thin capitalization. Implement debt pushdown strategies, pushing debt to countries with profitable operations. Be mindful of thin capitalization rules in different jurisdictions that limit the amount of related party debt. Acquisition costs and step-ups. Strategize to obtain relief for acquisition costs and consider the tax benefits of stepping up the value of assets to market values for depreciation purposes. Tax efficiency in international M&A transactions requires a deep understanding of global tax regulations, strategic use of financial instruments, and careful structuring of corporate entities.